The Income Tax Act 2025, continuing with day 36. Now I'll be studying a few of the remaining sections of the chapter, starting with section 62, which is the compulsory maintenance of books of accounts. It tells us which people have to maintain books of accounts and what books of accounts they need to maintain. Starting with the case of specified profession, which means the case of architects, medical engineering, technical consultant, those professions, or IT professional, those kind of professions. It says in those cases, if their gross receipts are more than 1,50,000 rupees in all 3 years preceding the tax year. So if the tax year is 26-27, we'll have to check 3 years before 26-27 and see if their gross receipts exceed rupees 1,50,000. And in case it is a newly established profession, then we'll check if it's likely to exceed rupees 1,50,000, and if it exceeds or is likely to exceed, then we'll maintain books as per rule 46. Now what is rule 46? It says the books of accounts that needs to be maintained are cash book, ledgers, journal in case the SSC is following mercantile system, copies of bills issued over rupees 250 and they should be serially numbered, copies of expenditure bills of rupees 250, of rupees more than 250s, and in case it is a medical profession, then they also need to maintain daily case register and inventory register. But if their gross receipts do not exceed rupees 1,50,000, they have to maintain only such books to enable AO to complete the assessment. Then there are other SSCs, which means those people who are not carrying on profession other than those SSCs, businesses and professions will be included here. So in case the SSC is individual of HUF, we'll check the PGBP or turnover criteria. In case the PGBP of the SSC exceeds rupees 2,50,000, 2,50,000, or the turnover exceeds rupees 25 lakhs in any of the 3 preceding years, or likely to exceed, then they will have to maintain such books as to enable AO to complete assessment. Similar is the case of other than individual or HUF, but in such cases, the limits will be rupees 1,20,000 PGBP or rupees 10 lakh of turnover. The point to be noted here is it's or, which means if either of the condition is satisfied, they will have to maintain such books as to enable AO to complete assessment. But if these conditions are not met, which means these limits are not crossed, then they are not required to maintain any books of accounts. There are certain special cases, as we have already discussed, as in section 58, where in case we did want to declare lower income and we opt out of presumptive basis and our total income exceeds basic assumption limit, then we have to maintain books and get them audited as well. Similarly, in case of presumptive basis for non-residents, in two cases, turnkey projects, and in case of mineral oil facilities, there was this condition of in case they want to declare lower income, then they have to maintain books and get them audited. These books have to be maintained for 7 years from the end of tax year, and in case they do not, there will be a penalty of rupees 25,000 rupees. Moving on, this is a case law Taparia tools completely unrelated to the section above. Deals with the treatment of interest on debentures, kind of. This is a case where they had issued debentures at a discount, means the face value was rupees 100 and issue price was rupees 65. They could have gone for normal route where they could have issued at rupees 100 and then paid interest of at any market rate, but they opted for going for discount and they issued it at lower than face value, which means the 35 rupees discount, it is kind of an interest payment, but it has been paid upfront. So the question was whether this interest payment would be treated in the first year alone, which means the SSC will get the deduction of whole 35 rupees in the first year only, or will it be spread out over the years of the life of the debentures. It means equal deduction for each year. The Supreme Court ruled in this case, stating that it will be treated in the first year only. So it will get entire deduction in the first year only. Now comes section 63, which is related to the audit of books of accounts. It says we have to submit audit report 1 month prior to the due date of filing of return of income, which means 30th of September of each year. This report is allowed to be revised before the end of financial year succeeding the relevant tax year, which means for tax year 26-27, the end of financial year succeeding the relevant tax year would be 31st of March 2028 for tax year 26-27. This is allowed because there are certain cases, like in the case of Section 37 or other cases where the SSC has to make the payment of some expenditure which exceeds 10,000 rupees. He is allowed to make such payment in banking mode only up to the due date of return of filing of income. Now, the due date of filing of return of income would be 31st of October, but we have to submit audit report only on 30th of September. So we'll assume that he will make the payment through specified banking mode and he'll be eligible for claiming deduction for the expenditure. But what happens is, if the SSC does not make the payment through banking mode, he makes the payment through cash mode, then we have to disallow such expenditure. And that is why we are allowed to revise the audit report before the end of financial year succeeding relevant tax year. Now, who has to submit audit report? Again, in case of specified professions, the limit is rupees 50 lakh. In case the gross receipts exceed rupees 50 lakh, they will have to get them audited. For businesses, the turnover or gross receipt limit is rupees 1 crore. In case it exceeds 1 crore, they will have to get audited. But this limit increases to rupees 10 crores if both the cash receipts and cash payments are up to 5% of the turnover, 5% of the total cash receipts or total payments, respectively. Means if the total cash receipts are up to 5% of total receipts of the business, and cash payments are only 5% of the total payments, then the limit will become 10 crore rupees, which means a business having a turnover of 10 crore may not need to get its books audited. Then there are again some special cases where the SSC is claiming lower income in presumptive basis under section 58.2 or lower income under section 61.2 for presumptive basis of non-residents. Non-applicable of section 63 for presumptive basis under section 58, we do not check these limits. There are specified limits under those sections only, like in section 58 there is a limit of 2 crore and 3 crore. Similarly, presumptive basis for non-residents under section 61, they have their own limits. In case of some business, there is not even a limit. If an SSC fails to get accounts audited, they will have to pay fees of 75,000 or 1,50,000. They have used the word fees here. Earlier, it used to be penalty, and then people would get waiver of such penalty. But now the word is fees, so it's kind of not possible to get waiver of such fees now. Then there is section 60, which is the taxation of branches of non-resident head office expenses. This is an example. There is a non-resident company, Heli Incorporated. It has a branch in Mumbai. The branch incurs its own expenses and has its own income, but Heli Incorporated, the head office, which is located outside of India, the branch in Mumbai has to send its share of head office expenses to the head office, which is located outside India. So, will the branch get the deduction of such expenditure? The answer is yes, but there is a limit to it. They will get deduction for such expenditure only up to 5% of the adjusted total income or the actual expenditure, whichever is lower. The maximum limit is 5% of adjusted total income. What is adjusted total income? It is the income before giving effect to unabsorbed depreciation, family planning expense, brought forward losses, or any deductions under chapter 8. And we also have to add back actual head office expenses while we calculate adjusted total income. Now, what happens in case there is a loss? Adjusted total income is a loss, then we'll check the average of the aggregate adjusted total income of last 3 years and we'll calculate using that only. But if it is the first year of operation and there is a loss, then no deduction will be allowed because it sounds a bit fishy. Last section is section 50. This section deals with clubs. like we already did in the charging section. Here's an example of a gymkhana. It receives fees from members and others. Any fees he receives from others will be taxable. And if he receives free fees from members for general services, as was discussed earlier, it is exempt. But if it provides some specific service to members and receives fees for that, it is taxable. This section says that the loss from this general service business can be set off against the income of these two businesses, specific service or from others, the fees we received from others. But there is again a limit. It will be maximum up to 50% of the total income before such deduction. Which means, let's say this specific service is giving a fees total income of rupees 10 lakh, and we have a loss here of rupees 6 lakh to be adjusted. 6 lakh loss, we can set off this loss with rupees 10 lakh, but only up to 50%, which means only 5 lakh will be adjusted from it. We can reduce 5 lakh from it, then the income will become only 5 lakh. That's it.